Good morning and good afternoon to everyone. Uh, my name is Miles, and I'm delighted to be here today to be with you to introduce our speaker and to listen to our topic for today. And this is going to be an exciting talk about how regulations can keep up with technology and how we have controls over such emerging technologies such as machine learning and AI. All right. So for today, our speaker, Dr. Broby, is going to be speaking on the following topics on how data analytics are helping enforcement and if regulatory filing can be fully automated, how the Regtech outsourcing industry is set to grow, and if companies are investing enough on regulatory technology. So our speaker for today, Dr. Daniel Broby, is member 82 of the CISI. He is a finance academic with research interests that revolve around benchmarks, indices, financial technology, financial time series, and the regulation of capital markets. He has written numerous peer-reviewed papers, as well as published books on index construction and fund management. Dr. Broby has also pioneered research in blockchain, distributed ledgers, and their applications in the fintech ecosystem. His research has a thorough grounding in financial market theory, focused on its practical applications. Dr. Broby has co-filed a US patent application for a system for estimating the value of a company using financial technology. And without further ado, let me hand it over to Dr. Broby. But sorry, before we get started, just a quick housekeeping reminder for all of you. If you could type in your questions into the Q&A box during the talk, and we will set aside some time later for Q&A for Dr. Broby to answer your questions. And without further ado, let me hand it over to you, Dr. Broby. So thank you for being with us today.
Great, thank you, Miles, and good afternoon, everyone. Okay, so as Miles said, we're going to talk about regulatory controls. And in that respect, no one really likes to be told what to do. Nobody really likes oversight as such. So to some extent, the idea that technology can transform what is a process which many of us dislike is presumably good news. But on the other hand, we have to think about it from the point of view of by using things like artificial intelligence, which mimic human interactivity via a machine, the question then becomes, are you doing it in the right way? And we'll try and cover some of that. So why is regulatory control important? It's always easier to highlight that by talking about from a numbers point of view. So since the credit crisis, 2008, according to Mark Carney, who was the former governor of the Bank of England, there have been fines on banks and financial institutions of over $320 billion. Now that's a lot of money. And so obviously you can see that all of those fines come from a failure in control. So compliance itself, on top of that, the compliance departments that people work in, is a major cost center. Now, when prior to returning to academia, I was a finance professional, hence why I'm a chartered fellow of the CISI. When I joined, the cost of compliance was less than 1% of industry costs. It's now between 5 and 6%, so really substantial burden on financial companies. The other thing, though, is that we like to think of our industry from a professional point of view of achieving good client outcomes. And part of the regulatory control is focused on effectively protecting client assets and protecting client outcomes. So in that respect, we don't want to just tick boxes when doing compliance. We want to be a little bit more sort of thoughtful about how you do it. So as a result, oversight and analysis go hand in hand. So this concept of regulatory control, oversight, compliance, and enforcement, as I'm going to explain, can now be done by machines. But we need it to be done by machines in an intelligent way. So the process of doing that is called Regtech, and Regtech is, I think you would think of it as a subdivision of financial technology, Reg standing for regulation and tech for technology. Now, in many jurisdictions, it's actually grown into a sector in its own right because of the number of third-party businesses that are spinning out as a result of all the applications that we're going to talk about. And likewise, our industry, finance, is actually the second most regulated industry in the planet, the first being the nuclear industry. And why? Because obviously we all want our finances to be protected, and we obviously don't want to be victims of either financial fraud or bankruptcy or even poor financial advice. So as a result, we are the financial industry leading the way in Regtech. Now that's extremely good news for other industries because the things that we're doing to look at our own regulation can be transposed and transported to other industries. So I live and work in Glasgow in the UK. We're going to host the climate conference in November, COP26. Think to yourself, if they do come to an agreement to reduce the carbon footprint on the planet, how are we going to actually enforce that? How are we going to ensure companies and countries comply? So the way that that will happen will be using very much the same tools that we're now using in finance. So we can think of ourselves as making a nice contribution to hopefully a good outcome for the future in the world. But from an academic point of view, the concept of Regtech is still fairly new, but it has been investigated. And the academics who've written and researched the subject have really divided into two groups. There are those that are looking at how regulatory data can be digitalized. In other words, how all information is being focused in terms of making it in a data way that can be usefully analyzed and usefully processed. And then there's a group of academics who are actually looking at it from the paradigm shift. In other words, how does it actually change things, not just to automate compliance, but how to make it better? For example, how can we detect fraud? How can we essentially use it to identify better client outcomes based on people's risk profiles, for example? So one of these academics, Buckley, well, a group of them, Buckley and colleagues in 2002, suggests that actually there are four pillars to Regtech, but that these are really unconnected. So there's the reporting requirement for financial companies, and all of your firms will effectively have reporting requirements to the regulator. And to some extent, these reporting requirements may well be something which can be handled by the compliance department, but it also could be handled by internal audit, for example. Data protection rules on privacy and confidentiality. And I'm going to talk a bit more about that because if we're talking about digitalization of regulations, we're talking about effectively the use of data. And the use of data is something which only now is really raising a number of issues because essentially data is the new sort of gold in terms of how and what you can do with it, as we know from the likes of Google and all of these other companies that basically harvest information on what we do day to day. Then I'm going to talk a little bit about the pillar that is open banking, because this is quite fascinating. And the UK, where I'm based, is leading the way in open banking. And so this is something which is going to change the nature of banking in the Philippines. And then we're going to talk about the digitalization of identity, because as you know, a lot of the things that compliance do with the clients is basically know your client and basically onboarding clients, which is all to do with identity. And to some extent, the idea that you determine identity by getting someone's telephone bill or electricity bill is really not suitable to a digital world, and is something which our industry really needs to improve on. So to do that, to improve, we need to basically focus on innovation. And the innovation that's really leading this way is digital innovation. And that's coming, it's really increasing in terms of the speed of change. Now, banks are traditionally quite conservative institutions. And as a result, weren't initially very keen to rush into this technological change. However, the migration of financial services to the internet and the rise of what are called challenger banks, new banks that are all digital, has really prompted the incumbent banks to now grasp technology. So much so that JP Morgan, for example, has the CEO, JP Morgan, describes his company not as a bank, but as a technology company. So in that respect, a lot of what these digital initiatives do is also change the way that people interact with their businesses that are regulated. And in that respect, over here in Europe, that has big implications, because actually 37% of people are really unhappy with the financial institutions that they work for, but don't change because of inertia, effectively. So we'll come and talk about APIs, application that basically interface with computers and all of this data. But the thing that you can get from an API is the ability to change customer in a world where you've introduced Regtech protocols that allow that to be automated. And that obviously has very interesting implications for new entrants and new products and new services. So in terms of business architecture, we have a focus on the technological side of digital innovation. And from a regulation point of view, this means that we've got tools for monitoring and basically radar, in other words, to look out there to see what's happening to things like, for example, systemic risk and the like. And also monitoring solutions that can be used to effectively look across an organization so that you can determine what is being done in accordance with the mandates of the individuals or the products that are being managed. Now, a lot of this can also be cross-referenced to things like, for example, behavioral analysis. So you can look at things like trading patterns and so forth and individual behaviors. Now, if you think back to some of the earlier financial scandals, so for example, the collapse of Barings in Singapore in your part of the world, that happened because an individual overextended himself, his trading limits, disguised what he was doing, but also started increasing and doubling up the bet because he realized he was getting into so much trouble, eventually putting at risk more value at risk than the entire bank's capital. That could have been identified with the sort of tools that we have today. So clearly doubling up on a bet in an investment context is not really a very good idea, and that's something that you can have tools to identify. Likewise, something that none of us like doing, and certainly was one thing that I had to do regularly when I was on the fund management side, is reporting. It's sort of something that is very time consuming and not necessarily very productive. But with tools, you can scrape the data, you can produce nice pie charts, you can have drawdown on charts that go into a standard formatted report, and with certain sort of tools like machine learning. You can even have predictive analytics that maybe bring in attribution from what your product, your fund, for example, has done, and build most of the reporting element for you. And then basically the human then interacts with a way that obviously improves and makes sure that it is useful for clients. So some very exciting stuff that can be done in terms of business architecture. In terms of function and process architecture, there we talking more about the software that can be effectively utilized to make for a better oversight process. And in that respect, you have to not just have compliance with your own processes in the company, but also your supply chain. So what do we mean by that? Your counterparties. So if you're doing a trade with another counterparty, you need to know that they are also compliant. So that sort of thing allows, that sort of software allows that interaction. Under function and process architecture, we can also know your customer better, and that sort of due diligence. And you can also data mine some stuff on your customer. So rather than doing it in the old-fashioned way, are you high risk, low risk, middle risk sort of client, asking them the questions when they come on board, you know, sort of my great aunt, if she's asked is she high risk, low risk, or whatever, doesn't know, because she doesn't really understand the concepts. And so we can look at her risk profile, we can look at the way she does spending patterns and so forth. So there are all sorts of assessment systems, and there's even things that are from a societal point of view useful, like for example a whistleblowing system that can be automated. Imagine that you in your company identify something that you think is wrong. Do you go to your boss and tell him about it at the risk of being fired? Do you put it into a little black box in a piece of paper and hope that someone picks up on it? Well, wouldn't it be better if the process is automated and anonymous and so forth? And so obviously these sort of things improve outcomes if they're well integrated into the company. There's also a number of applications that you can overlay on these system-wide ones that I've just talked about. And obviously I've mentioned that you can use artificial intelligence to detect fraud. For example, you can do clustering techniques, or so you could, for example, use techniques to look at the way that spending patterns happen. And you've probably sometimes had a ping from your bank and said, you know, sort of, have you purchased in this shop or whatever? That's because they're using artificial intelligence on your spending patterns to decide what you do. And if you're always going to a mall to do your shopping, and then all of a sudden you go to an upmarket LVMH shop or something like that, it creates a flag. That is useful to individuals, it's useful to society, and it's all part of compliance. Also, risk simulation. Sort of risk is something which is very difficult from a financial point of view, because as you know from your syllabus on the CISI, we use standard deviation of a time series of returns as a proxy for risk. But the person who suggested that our industry use that, Markowitz in 1952, also wrote in his dissertation, when he effectively wrote about mean variance portfolios, that he didn't think that standard deviation was a good proxy for risk, that he thought variance was better, but he didn't have a calculator or computer to work that out, because obviously that was 1952. So we built a whole industry on a measure of risk, which isn't actually a very good measure of risk. In fact, he was wrong. Actually, semi-variance is better than variance, because we're all more concerned about downside risk than upside risk. And there are a whole lot of other nuances to risk, which modern finance can bring to the table in terms of risk simulations that an individual can't conceptualize because the numbers are so large. As I said, Markowitz himself, he won the Nobel Prize for that, but he didn't have the computing power to think or do it, and certainly couldn't do it in his head. Also, there's all sorts of application architecture for cash flows and enterprise risk management and so forth. So what you're doing for compliance isn't just product compliance, but also is everything complied with? Are people following proper procurement process in the business? Because obviously you have to make sure your business is focused on all areas. The data integration architecture is important from the point of view of analytics and data mining. And in that respect, we focus on ETL tools, extract, transform, and load. And that's basically down to your IT department to ensure that essentially they understand the compliance process and what data you want to mine so that you can effectively make the best of the data that you've got. There's so much data. All we're doing is generating data from sort of a trading perspective or a fund management perspective. We are creating time series. What we do with those is obviously only as good as the technology systems we have. So with all of this amount of different ways of doing things, it's not surprising that some people actually just want to outsource the system architecture. And this is where this whole business of outsource is coming from. And in that respect, there's actually 4 different areas where people can outsource to. So you can outsource policies and procedures, you can outsource the monitoring, you outsource the filing of the regulations, or the anti-money laundering. And there are new businesses that are focused on each one of those. Don't forget that obviously we're in a business where we're trading and managing and overseeing assets. So the product payment architecture is also very important. And in that respect, we have to be secure. And as I said earlier, we're migrating the financial system from effectively bank-to-bank, peer-to-peer transactions over into the internet, which is from one-to-one to one-to-many. And that increases the amount of risk that is involved in the system. And certainly a lot of people are very enthusiastic about something like blockchain, but blockchain is on a distributed ledger everywhere across the entire internet. So as a result, you have to build into that sort of structure alerts and smart contracts that effectively do what you want in terms of the compliance, regulation, and oversight. Now, all the regulators, even over here, US and everywhere else, are really behind the curve on looking at how to oversee crypto assets, for example. And certainly there are a lot of transfer payments that are done. And I know that you have a large diaspora in the Philippines, in Hong Kong and Asia and so forth, who are using these sort of transfer payment methods to send money back to your country. But think to yourself about the security and compliance that they have with these various protocols. So as I said, it's all about digitalization. And likewise, if you think of where we're going with all of this, we're actually moving to sort of real-time reporting. So the idea that you file monthly regulatory reports, the idea even for reporting in accounts that you have one annual audit and a sign-off on accounts will seem quite archaic in 20, 50 years' time. So think of us as moving to that and how we have to change the regulatory process to address that. So artificial intelligence, effectively making computers think like humans, is something that obviously really helps us, because we can take what's been happening in regulation and take it to the next level, so we can be a bit more predictive about the sort of regulation that we're doing. So we're no longer just sort of bringing clients on board and checking that we're doing the right things with a fund or whatever, that we're starting to think in terms of, as an individual, for example, ask yourself, do you know what your own net worth is? i.e., do you know what the value of your house is, what the value of all your pension funds, your insurance products, or all your assets, shares, money in different bank accounts and stuff like that? The answer is no, but why shouldn't you? In real time, you should be able to know what all your financial assets are worth. And then think about extending that to effectively knowing what your liability are. We know your longevity from an actuarial assumption. We know what you'll need to retire on. And so in real time, if we knew what all your assets were and what all your real long-term liabilities are, we can create for you an optimal asset allocation in real time that changes and can be automated. And the regulatory process can ensure that you are being given an optimal outcome on your assets. So these are visionary things, things we're working on in a sort of research capacity, but it's interesting to know where we're going with this, because some people might think, well, it's happened, we've already got technology here in the compliance room, but think where it's going. It's moving real time, and you're starting to get far more applications with what you can do with prediction. And most of that predictive stuff is on the risk oversight area. And bear in mind, we've got three types of market risk: credit risk, market risk, and operational risk. And all of those need predictive stuff. So you don't just need predictive analytics on your credit portfolio if you're a bank, but you need to understand where you are in terms of market risk. And again, you've all done that in the syllabus, looking at systemic risk in the market or whatever, but also operational risk. You know, sort of, have you lent too much to one person who could potentially default on you? You know, 10% of your bank lending book to an industry. You know, you have unforeseen things happen, like, for example, COVID. So you need to have and test different scenarios. And over in Europe, following the credit crisis, we now regularly stress test our banks. And obviously, in that respect, you can use artificial intelligence to do that. So this digital transformation, where we're moving to the internet, means that we're also changing the sort of devices we're using, and we're changing the way that Regtech has to focus on that. And you've all presumably got mobile banking and so forth, but think to yourself how the compliance considerations change on that, but also how liquidity transformation changes in a banking from the sort of top level of the bank. What sort of data issues there are, and can you actually trust these devices and so forth, and what's happening with competition. In terms of the way that the banking world is sort of splitting up, it's basically you've got this disruption happening, but that's happening in both the front and the back office. And that's an area where obviously compliance has to bridge the gap from that. All of our delivery channels are going to be transformed, some totally digitally, some hybrid. You'll still have, for the time being at least, to speak to a mortgage advisor, but there's no reason why in the long run, for example, you can't have an automated solution that identifies the optimal mortgage, the duration of your mortgage, your repayment profile, your affordability, and things like that. So I said I'd touch on open banking, and in that respect, so open banking is the transfer of the ownership of that data in your bank account to the individual. So the ownership changes, and you can then permission a third party to have that ownership. So why is that important? Well, it's important because that data can then come into the public domain, and you can give it to a third party to do something with it. So with artificial intelligence, they can analyze your risks. They can look at a number of factors, like what your real-time credit risk is, rather than what a credit risk agency thinks it is. So all sorts of new businesses that come from that, and that's what's driving the fintech revolution over in the UK and in other jurisdictions that have adopted open banking. So it's also creating new functions, so information account service providers and payment initiation service providers who are handling this data and taking this data and doing stuff with it. And those are new regulated entities, all of which will need Regtech solutions to their oversight. The way that that data is gathered and harnessed is through an API, an application program interface, which is really just the interface between a machine and the computer and the user. And in that respect, that API also is doing stuff. It's taking valuable stuff from one place and moving it to another, which needs to have compliance and oversight. And then you get the fact that actually you start to integrate multiple APIs, which is the future. This will be sort of coming to your jurisdiction and so forth. So as that happens, you then have multiple challenges on the compliance and the oversight. So in conclusion, so regulatory technology covers a whole lot of things. I haven't even talked about tax compliance, but you can now see how, for example, these sort of intelligent ways of looking at things are actually able to sort of cover different things. So we've also got the information systems. Again, I haven't covered things like cybersecurity, but obviously that also is now a big threat. If everything has digital access, how do you protect your organization in that respect? But I've talked a lot about regulatory reporting, automating financial crime and so forth, and financial and risk. So I hope from that you can see that actually there's a brave new world coming to automation of all the things we don't like doing. And with open banking, where that data that we're talking about is effectively permissioned to do stuff, we're also getting whole new industries created that can do interesting stuff and personally tailor financial solutions for us in the future. So, questions? So over to Miles.
All right. Thank you very much for that, Dr. Brovey. Again, really, really interesting topic, and I think very timely with, firms ever increasing, speeding towards the adoption of technology. I think it's a really relevant topic to discuss. Again, just as a quick reminder to all of you, if you can type in your questions in the Q&A box. And I will start off with our first question. Is open banking, in your opinion, safer than traditional banking?
So open banking has only been really fully introduced in a number of jurisdictions, just a handful of jurisdictions, of which the UK was the first. And in that respect, the banks dragged their feet in the rollout of allowing APIs to access banking data. As of now, there haven't been any major data breaches. So we do have application interfaces that are taking data out of a bank and providing it to a third party. So, but clearly that process is risky. So the idea that it's riskless is obviously that we can't say that because there's a transfer involved. However, what is more interesting is not really the risk of the transfer of the data, but what's going to be done with that data. And I think that's where the exciting area lies in open banking.
Right. Thank you for that. And just linking it to your response over there in terms of, you mentioned that banks are cautious about sharing their data. Do you think there are any challenges in adopting Regtech? Are sort of regulators also welcoming these changes, and sort of take, for example, with the use of AI or machine learning, what sort of and recognizing, of course, that various markets and countries may be in various stages of evolution in sort of their regulatory response to these technologies. How do you see that playing out in terms of encouraging the use of AI and machine learning for the adoption of controls?
Yeah, so the biggest challenge is actually a regulatory one, funny enough, which is global data protection. So in Europe, we have a global data protection regulation that effectively means that people have a right to privacy, and many jurisdictions have this. Obviously, a right to privacy also, to some extent, conflicts with a digitalization and a world where data is freely available. So as a society, we still globally haven't really thought about the implications of the free availability of data over the internet and basically how to regulate that. So I think that that's the biggest challenge, and each jurisdiction is going to approach that differently, which is going to make it even more difficult from a compliance and oversight point of view, because, for example, we in the UK have more data privacy than they do in the United States. So a US bank doing activities in the UK has to be aware that obviously they're doing things very differently from the way that they're doing it in the US.
Certainly, that's very true. Thanks for that. And you know, just in terms of just taking a different angle on things, as firms increasingly adopt various technologies in terms of, let's say, in operations, which where my background is, you know, we're increasingly leveraging tools to, you know, technological tools to innovate and automate various functions. And while that somehow transforms the data, what do you think are sort of the trends that you observe in terms of regulators' expectations in terms of controls and governance around the adoption of technologies for in banking?
Well, certainly in the UK, the FCA is very keen to see greater automation, and regulators are trying to work out ways to essentially, from their point of view, so from the supervisory point of view, which is subtech, if you want to call it that, that their filings can be receive sort of common format. There's also discussion about how to maybe put identifiers like financial identifiers on various data points. So net income, for example, put an identifier on that so that data can be more readily accessed in, for example, a data lake, so that more can be done with the data that's collected. And that's really quite, you know, sort of these are things that the regulators are thinking about but haven't done. So, for example, take hedge funds. We all know that a large number of hedge funds have leverage, but we don't know how much leverage there is in aggregate, or even because hedge funds don't actually publish their leverage rates, even at an individual level. But obviously this is systemically important because obviously leverage carries with it risk.
Thanks for that. And just, you know, from your experience, I mean, you can take the FCA as an example. Where do you see the trend lies in terms of how regulators are, you know, creating their rule books? And what I mean to say is, you know, is it in the direction of being more prescriptive, or is it more of sort of outcome based? And which kind of path do you think is better suited to facilitate a healthy, you know, ecosystem of adopting, you know, technology?
Yeah. So this is one of my sort of pet sort of gripes about the regulator. When you mentioned the rule book, the rule book in the UK is so long that you would spend a lifetime reading it because essentially it just keeps getting longer and longer and no one does any sort of pruning. So, and that actually means that you do need artificial intelligence ultimately to be able to do it. But it also means that there's risk in the fact that actually, you know, sort of there isn't a holistic oversight from a sort of human point of view. You know, so what are all the different regulations, rules and regulations are. So maybe it's time to sort of halve the number of regulations and sort of focus more on principles than rules. So yeah, I think that the regulators certainly need to work out not just how they can, sort of have an automation of the rule book, but I think they also need to think about how the rules apply in a sort of digital context. How do you audit a crypto asset, for example? Something that can be at a touch of a button transferred globally in seconds and so forth. And what is the value of that when you look at the volatility of the underlying asset and so forth? So there's an immense number of issues that need to be addressed from the regulatory point of view, from a sort of a top-down and even philosophical way to how you handle a lot of these issues.
Yeah, it'll be very interesting to see how things evolve in that space. And yeah, we do have another question here from the group, which is, what are the major or key regulatory requirements out there that need to be met to reinforce controls for tech changes like AI and machine learning?
So in terms of, if the question is, how do you actually regulate the software that creates an AI or software that creates machine learning? That's exactly the same as I was just saying. The lawmakers really need to think about that. So for example, bias in AI. Suppose you are in a bank in a developed country and you're using AI to identify whether to extend loans. You then get the problem that you will get unintended bias. So for example, if you're purely leaving it down to a machine to make a loan decision, it may look at a jurisdiction, let's take Nigeria for example, and say this individual comes from Nigeria, reject loan. Now, Nigeria is a population of 80 million people. And although Nigeria has issues with financial fraud and with money laundering and so forth, that doesn't mean that all those 80 million people are obviously criminals. In fact, the majority of them aren't, or the economy wouldn't function at all. So as a result, AI does need to have sort of it has to be understood. And there are some people calling for regulatory oversight, and that's, I guess, is the reason behind the question. And so how do you oversee something which is software code? And that's very, very difficult. And the good news is that it creates a whole new industry of people, sort of software compliance people who will look at coding. And it's not just the AI and the machine learning, but it's also smart contracts. So basically, contracts that automatically execute. And those contracts are written by computer code, but you don't want a computer coder to put in, transfer 0.5% every transaction to my private bank account. And yet the regulators can't read that code because they're not trained in Python or such like. So there's going to be a new job description in the future. And that's the great thing about technology. For those who are petrified that AI and machine learning are going to basically lose everyone their jobs, you think to yourself, well, actually, there are new industries. I've just shown 2 industries created from open banking, and there is also going to be sort of regulatory oversight industries and so forth. Likewise, the question asked about machine learning. The thing with machine learning is that for the machine to learn anything, you need effectively for that machine to have a supervised data set. Well, you can do unsupervised learning as well, and even semi-supervised learning, but you need a data set from which it will learn, and that data set has to be true and correct. And obviously in the real world, identifying whether a data set is a true data set presents a problem in its own right. So therefore, the output from machine learning, we can see the benefits of it, but it's not always sort of correct. So for example, facial recognition software, which is used heavily in a country like, for example, China. If you wear a t-shirt with lots of different faces on it, that facial recognition software will identify 30 different people. So it's still not at a stage where it's foolproof. Obviously, it's still learning in that respect.
Right. And do you see regulators, adopting sort of an approach of, creating sandbox environments so that firms can indeed leverage these, technologies and be able to fail and learn from those? And have you seen any sort of early results and what outcomes there have been from those kinds of exercises?
Yeah, so for those that don't know, a sandbox approach is effectively a way that companies with new technology can actually interact with real clients with the sort of regulatory oversight to ensure that things don't go wrong, and a protection that if they do go wrong, that no client gets hurt in the process, which is really great for innovation. It's not the only approach. The Americans use what are called no action letters. In other words, they will say that they will send a letter from the regulator saying, you're experimenting with this new sort of technology. As long as you keep us in the loop, no action will be taken in the event of any failure of that approach. So both approaches are legitimate, I guess, in respect of encouraging innovation. In terms of the issue with them, the issue is, once again, that the regulators don't necessarily have the skill set of oversight yet. And that's obviously a risk when you're dealing with client money. You're on mute, I think, Miles. If that's... Sorry.
Apologies for that. So I see we don't have any other questions from the group. So I think unless you have any parting words, we can wrap up this session. And I'd like to thank you again, Dr. Bobby, for being with us here today and sharing some really thoughtful and insightful information around this topic. And to those of you who joined, again, thank you for watching in, and you have a great rest of your day.
Okay, thank you, everyone.